Every month for the past 5 years, I have put some money into my investment portfolio when I got paid. Some months are quiet, and others, like this one, are pretty exciting. I sold a chunk of my global index fund, I added a brand new stock to my portfolio, and I invested nearly £2,000 into one of my highest conviction companies. So in this video, I'll walk you through the accounts I use, the stocks and funds I invested in, and why I chose them. If you'd like to stay updated on my investments and portfolio performance, then make sure to hit subscribe. Now, let's get into it. There are two types of investment accounts that I contribute to every single month, both of which come with tax advantages in the UK. The first is a self-invested personal pension, also known as a SIP. Since I'm self-employed, this is my version of a workplace pension that most people will automatically be enrolled in by their employer. And I keep my investments in this very simple. At the minute, I just add £1,500 directly from my company to the Vanguard FTSE Global All Cap Index Fund, which I did once again this month. This invests in thousands of small, medium and large companies across the globe. And I want to keep this account simple and well diversified. Since it's effectively my retirement pot, I don't really want to be going around and taking unnecessary risks. I also don't want to commit to having individual stocks that I know I will need to monitor for decades. It's just a pot of money that I'm hoping to grow in the background with minimal effort. However, there is a place where I do invest in plenty of individual stocks. And this month was particularly interesting. That is a stocks and shares ISA, which is currently my largest and main investment account. Investing using a stocks and shares ISA allows me to invest without having to pay tax on any gains or income. Crucially, it doesn't lock away my money, unlike a pension, which does lock away your money until the age of 55. And that age is set to rise to 57 from 2028. Now, before I get onto the investments that I bought, I want to quickly outline the approach that I take when it comes to investing. I have a long-term view, meaning I aim to invest in companies for at least 3 years. I try and look for the highest quality businesses out there with strong, sustainable competitive advantages and clear room for growth in the future. I'm also a big fan of founder-led businesses, especially when the management team own a good chunk of shares themselves, meaning they have plenty of skin in the game. With that said, let's get into the investments I made this month. I've decided that I'm going to go in reverse order, starting with the smallest investment I made this month and ending with the largest. Now, this first company is already one of the largest investments in my portfolio, and its shares jumped by 10% last month after some strong results. But I still wanted to add just a little bit more to it. So my first investment this month was £50 in MercadoLibre. The lazy way to describe MercadoLibre is like the Amazon and the PayPal of Latin America, because the two main parts of its business are an e-commerce platform in MercadoLibre and a digital payment system in Mercado Pago. Beyond this, it has a logistics fulfillment platform called Mercado Envios, which is helping the company to deliver packages quicker and at a lower cost, creating a strong competitive advantage, just like Amazon has done over the past decade or two. Those are probably the main parts of MercadoLibre's business, but it also has a fast-growing advertising platform, a fast-growing credit business, and it even has an entertainment business in Mercado Play. It's following a very Amazon-esque model: create a stellar e-commerce business and then add more and more services on top. But what sets MercadoLibre apart is the fact that it has been able to become the biggest business in its industry within South America, a market that multiple companies, including Amazon, have struggled to gain traction in. That's because it's not necessarily an easy place to do business. MercadoLibre's biggest markets in South America have been prone to economic instability, currency fluctuations, and political uncertainty over the years. Most recently with Argentina having triple-digit inflation, and then electing a guy whose running mate was a chainsaw. But despite these challenges, MercadoLibre has managed to consistently grow its marketplace, expand its financial services, and strengthen its logistics network. In fact, the company's annual revenues have grown from just over $500 million a decade ago to more than $20 billion by the end of 2024. Now, I first invested in MercadoLibre in 2021, and the company has delivered consistently impressive results ever since. Its latest report in February showed more of the same. Strong growth across all segments, record user engagement, and growing financial services. I'd say the main reason I chose to top up on my MercadoLibre investment this month, even if it was more of a token amount, was to show that a company's shares don't have to come crashing down in order for it to look like an attractive investment. If a business is executing well and shares are reasonably priced, then it shouldn't matter if the stock price has gone up or down in the last month or two, because the stock market really only cares about one thing: the future, from this point right now. And I think that future looks very bright for MercadoLibre. Now, I'm not going to go into too much detail on my next investment, which was adding another £100 to my existing investment in Alphabet, the parent company of Google and YouTube. That's because I did a deeper dive on the company in my monthly investment video last month, and my reasoning hasn't changed. It's one of the strongest businesses probably to have ever existed, and I think its shares are looking quite attractively priced. And for now, I'll leave it at that. Although if you are curious, you can always have a listen to last month's video to find out more. Now, before I move on to my next investment, I need to talk about the first of two sales that I made this month. First, I sold £1,000 worth of my global pie. This is a little DIY fund that I created on Trading 212 that simply invests into global index funds. By the way, if you also want to start your investing journey using the platform that we trust with our stocks and shares ISAs, our viewers can use promo code SNS bonus to get free fractional shares worth up to £100 when they join Trading 212. This is an affiliate code, meaning that we get a small payment which helps support our free content. Now, back to my £1,000 global pie sale. 92% of the pie is invested in the SPDR MSCI All Country World ETF, which invests in thousands of medium and large companies across the globe, and the remaining 8% is invested in the iShares MSCI World Small Cap ETF, which invests in thousands of small companies across the globe. This global pie gives me a very hands-off approach to investing. It currently accounts for about 25% of my stocks and shares ISA, but I gradually want it to make up a larger part. One way I aim to achieve this is by occasionally trimming about 5% of my individual stock investments, all of them, and moving the proceeds into my global pie. I tend to do this after a period where my individual stocks have performed well and can feel a little bit expensive. But I do allow it to give me some flexibility the other way around as well. If I see what I think is a great opportunity to invest in individual stocks, or I want to add a new company to my portfolio, I will allow myself to sell some of the global pie to fund it. And that's exactly why I sold £1,000 worth of the pie this month. £500 went toward a brand new investment, and £500 went towards what looks like a really great opportunity to add to an existing investment. But let's start with that brand new stock that I added to my portfolio. This month, I decided to add Croda International to my portfolio, investing £850 to start a brand new position. Now, this isn't my usual type of investment. On the face of it, it's quite a boring company that should keep chugging along at an okay-ish rate. But I think there's a good opportunity here. So Croda International is a UK-based specialty chemicals company. It's one of those behind-the-scenes companies that makes the ingredients for everything: personal care, beauty, home care, fragrances, pharmaceuticals, vaccine adjuvants, crop care, coatings, textiles, fibers, water treatments, and that's before diving into some of the more niche markets that it serves. Basically, if you've ever looked at the ingredients list on a household product and had no idea what half of them were, then there's a good chance that some of them came from Croda. Now, remember how I told you that this is a boring company and is meant to be a steady stock? That was true for the best part of a decade, until the pandemic hit, and shares of Croda went on to double in under 2 years, before tumbling by almost 70%. And it's both of these things that have led me to think that Croda could be a pretty good investment today. So why the roller coaster, and why are things looking so bad for the shares now? Well, a few things happened. First, Croda plays a key role in the production of lipid nanoparticles, which are key ingredients for COVID vaccines. So their revenue boomed during the pandemic. But like many stocks that got a pandemic boost, that was followed by a pandemic bust, as demand for COVID vaccines slowed dramatically over the past couple of years. But Croda's pandemic boom wasn't only driven by sales of lipids for vaccines. Since Croda's ingredients are crucial to its customers' products, and nobody knew what was going to happen with supply chains, Croda's customers placed huge orders to ensure they'd have enough inventory of Croda's chemicals to make their own products if supply chains got disrupted. This is known as overstocking, where these companies bought way more of Croda's ingredients than they needed at that point in time, because they wanted to ensure that supply chain issues didn't hit their business's ability to operate. Remember, Croda's ingredients are essential building blocks to so many products and industries. Now, Croda's customers have been working through the excess inventories, but slowly, meaning their orders with Croda have dropped substantially, which makes sense. You don't need to order more ingredients from Croda if you already have a shed load in your own storage facilities that you bought the year before. Naturally, that caused Croda's revenue to spike when these companies were overstocking, but revenues have since fallen as Croda's customers work through their inventories, which they have been doing for quite some time. But things are expected to get back to normal in 2025. So it's been a hectic period. But here's one thing to remember. Croda's core business remains solid. This isn't some company in perpetual decline. It's just working through a very weird period of time. But the stock is priced like the company's permanently broken, which I really don't think is the case. So my thinking is pretty simple, as it usually is. Croda is a high quality business that got embroiled in a short-term boom and bust through very little fault of its own. Shares might have got too high, but in my opinion, they look far too cheap right now. If the company shows that it's more than just a pandemic boom and bust story, which I think it certainly is, then I reckon it could make investors very happy over the next few years and beyond, which is why I was happy to add this brand new stock into my portfolio. Right, let's get onto the big one. Normally, investing 850 quid into a brand new stock would be the big story of my monthly investments. But over the past month, I have added £2,000 to an existing holding, making it probably the largest monthly investment I have ever made in one stock. 500 quid came from new money added to my portfolio, 500 quid came from the sale of a portion of my global pie, and a very recent £1,000 came from the sale of my entire Nasdaq 100 ETF, which was a very small position relative to my portfolio, because I think I have enough exposure to US tech through my global pie and my individual stock picks. So I took all this money and topped up my existing investment in the trade desk with £2,000 this month. As a quick overview, the Trade Desk is a programmatic digital advertising company, which sounds like a load of jargon, and it is, but it simply means that the company's platform automates the buying and management of digital advertisements across websites, apps, and streaming services. Advertisers set their budget and targeting preferences, and the Trade Desk's platform instantly finds the best places to show their ads using real-time bidding. This makes ad spend more efficient by leveraging huge amounts of data to target the right audience and adjust campaigns in real time, meaning better results for advertisers and more customers for the Trade Desk. Now, there's a few rare companies in our portfolios where we have always said, the second that shares don't look expensive, we need to buy them, because they are truly some of the best businesses around. The Trade Desk has always been one of these. So with shares down by over 40% in just a few weeks, it was time for me to put my money where my mouth was. So the question, and the important question to ask, is why did the stock crash? In short, they reported disappointing results. Revenue in the final 3 months of 2024 came in below the figure that management told investors to expect. This is known as guidance. But what's crazy is that this was the first time in 8 years that the Trade Desk has missed its own guidance, which kind of speaks to the quality of the business. But even the best companies will have bumps in the road to success. The main reason and the main issue for the quarter was that they delayed the full rollout of their new AI-powered platform, Kokai. There was no fundamental issue with the platform, but rather smaller enhancements that they wanted to make to Kokai before the full rollout. However, this was still a misstep from a usually perfect company, something that co-founder and CEO Jeff Green acknowledged, which may sound like nothing, but having a CEO who actually holds their hands up when things go wrong is not a guarantee. Truth is, Jeff Green is one of the best, if not the best, CEO of any company in our portfolio. So he is someone I trust to steady ship after these small missteps. There was also one extract from Green from the earnings call that I think any long-term investor should pay attention to. He said, "In Q4, there were a series of decisions we could have made to enhance the short-term performance of the company and neglect the long-term. We consistently choose to focus on the long-term opportunity and maximize our market share over the long term, as I believe it is in the best interest of all our stakeholders. We are keeping our focus on the massive long-term opportunity. Basically, they could have rolled out the Kokai platform earlier to please shareholders by hitting Q4 targets, but it meant rolling out a product that wasn't up to the company's high standards. So they didn't do it. The market might not like it, but it feels like the right thing to do for this company to maintain its reputation as an industry leader. In fact, that's what the decision about whether or not to invest in this company after the missteps boils down to. Is there a fundamental problem with the business that will have a long-term impact? Honestly, I really don't think so. They just prioritized long-term quality over short-term results, which honestly is what I want to see from a business and a CEO. The trade desk has always been one of the highest quality names in both mine and Andrea's portfolios, and I don't think anything from its latest results will change that. The only difference is that shares are almost half the price they were a few weeks ago, and this, to me, feels like one of the biggest opportunities I've seen for a while, which is why I more than doubled my investment in the trade desk this month, adding £2,000 to my existing investment. Sadly, I can't predict the future, but I feel confident that I'll look back on this investment in a few years with a smile on my face, but only time will tell. That's a wrap for my investments for this month. If you want more videos like this, be sure to check out Andrea's monthly investment video from last week. And if you'd like to follow along with our investing journeys over the coming months and years, don't forget to subscribe to our channel. Thanks a lot for watching, and I'll see you next time.